Everybody. Welcome to this week's iteration of our Trade and Tariff webinar. If you're joining us for the first time, my name is Michelle Conley. I work here at World Trade Center, Utah, and we host this webinar every week to provide information to the business community about the latest happenings in tariffs. It's obviously a rapidly changing topic, so we're happy to be able to provide this information. A few reminders, we are recording today's webinar and it will be posted on our YouTube page along with all of the past webinars, which we've been hosting weekly most of this year. So feel free to check that out to look at some previous topics. We also encourage questions and discussion, so please feel free to use the chat function and chime in at any time with questions that you might have. Today, excited to have my colleague, our Chief of Staff, Ben Kolendar, and Tariff Whiz join us again to walk through the tariff dashboard that he does an expert job at keeping updated. And then also really thrilled to have Mark Madrian join us today. Mark is a transfer pricing partner with Tanner Accounting. He has 25 years of experience and expertise in transfer pricing, and he's going to talk to us today about how transfer pricing and tariffs kind of work together and can maybe be utilized to help your business. So really looking forward to hearing from him and appreciate him joining, and appreciate Tanner as one of our members here at World Trade Center, Utah. Without further ado, I'll kick it over to Ben to tell us what has gone on this week in the world of tariffs. Ben.
Thanks, Michelle. I'm going to share my screen. So, as we do every week, I'm just going to remind the group, if anyone's new, we have our tariff dashboard on our webpage. It's publicly available. We track all these updates and provide all the primary source documents here in one place. So if you're looking for specific language or guidance on what's been released and you want to know where to check, this is a great resource to do it. So our website, WTCUtah.com/tariffs, has all this information we're going to go through today. And I'm just going to, if you want to share this with others as well, I should say that our link to our Friday webinars is on there as well. So I'm going to scroll down for a bit to go off of some of these updates on our dashboard. The big one I want to cover up front is our the de minimis. So we've heard from some businesses that they will be impacted by this the suspension of de minimis, but not a majority. But it's still good to keep track of and know, because maybe it impacts a supplier to your business or others. But the effective date of this is coming up. It's next Friday. So next Friday's webinar will by then have the suspension for de minimis in place. There was some action last night that CSMS released some information about qualified importers. So just to go over this briefly, we have two qualified importers right now, Safe Package and Zonos. So those companies are qualified to collect and pay duty on de minimis coming through. So an update coming through last night, just to be aware of, and that this will be going into effect 1 week from today on the 29th. Another brief update, we talked about this last week, but some of the additions for steel products on the 232 tariff went into effect on the 18th. So that was earlier this week. It was announced the prior week, but those went into effect. And so we have all of the links to the documents on the additions and what was added on our website. So if you need to go in and check those, or if you're wondering if your product is included or not, you can go check that and see. The last update in terms of the tariff side of things, and I'll get to deals in just a minute, but the last update in terms of their tariffs is there was a launch of a new 232 tariff on wind turbines. So if you are a company is doing any work in wind turbines or any of their parts associated with that, you will want to track this one and provide public comment as well. So a reason we're often asked, why should I provide public comment on some of these tariffs going through? And the real reason is it gives a potential remedy down the line through the process or an exemption sometimes for your product if you have a good case to make on why your product should be exempted and not included in that 232 tariff. So exemption possibilities or legal remedies down the road are the reasons that you really want to comment. And sometimes you could do that anonymously. The government does have to take every substantive comment into account when implementing these tariffs. And substantive means you can't just say, I don't like it, but you have to really give a real reason and behind why that tariff will impact you negatively and maybe not have the intended outcome that the government wants. So one thing about this tariff before I go into deals, you could see on the BIS page when turbines, it was just initiated, it says August 13th, but when you go to the Federal Register notice right now, it's still tagged to unmanned aircraft systems. So we don't know exactly why it's that way, but we're going to track this and you'll see our timeline and everything associated with this is going to be updated as soon as the primary source documents are linked to the appropriate place. I even did a search on the Federal Register and I couldn't find anything on wind turbines yet as of last night. So transitioning out of tariffs for a minute, we did have a bit of news break earlier this week on deals. I'm not going to go into this too much. I definitely want to give Mark some time to talk about transfer pricing. But the big update was on the EU. There was basically a more detailed term sheet was announced on the 21st about our dealings with the EU and what the terms are in terms of investment that is taking place, some better market access in the EU. And as was captured earlier, it sets a floor of 15% on products coming in from the EU and MFN status, across the board for things that are higher than that for the EU. So just something that we'll go into more detail in a future webinar. We were just talking internally about the importance of it's probably time for us to go back and review with our business community some of the deals that have come through and update our businesses so they know how to really go on offense for some of these deals. We do track them on our webpage, so you can see this right here, all the latest that we're tracking, but maybe having some more discussion or around those deals would be beneficial, and we have that in discussion for a future webinar. So stay tuned. And with that, I'm going to stop sharing my screen and hand it off to Mark.
Great. Thanks, Ben. Are there any questions for Ben before we move over? Great. Mark, excited to hear about transfer pricing.
Yes, let me see if I can get my screen to share here. 1 second.
While you're doing that, I was just going to share, we were talking right before this started about the dashboard that Ben and World Trade Center put together and how we haven't been able to find a public version of something similar. And Mark was sharing that, some of the other big accounting firms have that, but it's kind of locked down for their customers and their members. And so I'm just proud of Ben and think it's really cool that we've been able to provide something like that publicly. So hope it's helpful for all of you that are on the webinar. So yeah, Mark, take it away.
Good. Everybody can see my screen, right? We're good? Okay. Appreciate the opportunity. Thanks, Michelle and Ben and the World Trade Center for inviting me to speak today for a few minutes. Before I jump into my slides, and I have about 8 slides I want to share with the participants, let me just start out by giving a very high-level description of transfer pricing for those who aren't familiar with it. So transfer pricing is an area of international tax that most countries have rules related to regarding how related parties interact with one another when it comes to cross-border transactions. And in its simplest way, transfer pricing is intended to, it's a process for us to allocate profits or losses among related parties that are part of the global system, if you will, of a multinational company. And that process is largely driven by what functions does each of the entities perform, what risks do the entities assume, and what assets, primarily intellectual property, do these entities own. And by going through that analysis, we can figure out how to allocate profits or losses between or among related parties. We also look at both sides of a transaction because we are dealing with related parties. We can't just focus on the US consequences. We have to look at what happens if I adjust a transfer price. What does that do to the other side of the transaction? Let's say I have a manufacturer in Mexico that I'm purchasing from, and if I'm trying to tweak those prices, what implications does that have for my Mexico income tax filing responsibilities? So it's a two-sided or multi-sided analysis. Couple more thoughts. In talking to colleagues at other firms and that are in the industry, I think the consensus right now, at least as it relates to transfer pricing, is probably similar to what it would be for companies that are buying from true third parties, and that this seems to be more of a short-term or near-term problem from a transfer pricing perspective until companies can kind of sort out both their supply chain, how can we make adjustments, as well as how permanent are some of these tariffs? Are they going to change? We know the administration will turn over in 4 years. So obviously you don't want to, if you think there's going to be a change in administrations and a change in policy, how much do you want to invest on bringing manufacturing from a related party offshore to an onshore party that you can then purchase from? So a lot of these issues we're dealing with right now are near-term issues, and longer term, those will be dealt with at some point. And the other aspect of this is that just as arm's length parties, so in other words, if I'm buying from a third party in China, I'm most likely going to be negotiating with that party about tariff costs. Okay, are you willing to share some of these? Am I going to have to bear all these? How can we kind of work together to ease the pain for the parties that are involved? Well, related parties have the same opportunity to look at what we call realistic alternatives. And so it is expected that related parties will also probably go through a similar negotiation process. So if I have a manufacturer in Mexico, I'm going to talk to that manufacturer about how much of this cost can you absorb in the price of the product that you're selling to me. So with that in mind, let's just go to the next slide here. And what I've tried to do here is at a very high level kind of summarize the customs and transfer pricing issues that get looked at. Obviously, enforcement is done by U.S. Custom and Border Protection. Transfer pricing is by the IRS. Now, in some countries like Canada, these two agencies are very closely tied together and will frequently communicate with one another and share information, and will use that, whether it's typically customs will come in and say, we found this issue with this U.S. multinational, and the next thing you know, the Canadian Revenue Administration calls you and says, hey, we want to talk to you about some information. We don't have that same coordination on the U.S. side, for better or for worse. They don't talk like they do in foreign countries, but so they kind of act very independent of one another. There's tension. If I have a higher transfer price when I bring a product into the U.S., obviously there's a higher tariff that's going to be paid, but it's also going to affect the amount of income tax I pay at the end of the day. If I have a lower transfer price, it's the opposite effect. So we've got this built-in tension between customs and duties and transfer pricing that we're always trying to balance. The taxable base for customs is transaction value. For transfer pricing, it's the profitability of the taxpayer. The timing of the tax, when you have a customs and duties, it's paid at the time of entry into the country. With transfer pricing, that payment can be made over a 12-month period or at the end of the tax period. So we're not under the same requirements to report and pay taxes related to transfer pricing as we are with the customs. The responsible party for customs obviously is the importer of record. For transfer pricing, it's the corporation or the taxpayer, which could be two different people depending on how the company is structured. I won't go through all the methods. I have highlighted in purple the primary methods for customs is transaction value. For transfer pricing, when we're dealing with tangible goods, we call it comparable profits method, and I'll walk through an example in just a moment. But there are other methods that we can use, and if you're interested, I'm happy to point you in that direction. You can read about those. With customs, the level of application is on a transaction by transaction basis. With transfer pricing, we're looking at aggregate profit or losses of the taxpayer. So we're not going in looking at individual transactions and trying to price those. We're saying you function as a distributor, you purchased X amount of products from a related party, how much profit did you earn on the sale of those products? That's how we view it from a transfer pricing. And then the enforcement penalties, you can see those for customs and duties. And for transfer pricing, they can actually be pretty draconian. If you underreport or if you don't do the necessary compliance, the interest and penalties can be very substantial. So again, some tension there between where do we spend our compliance dollars. I'm going to give an example that hopefully illustrates the interaction between transfer pricing and customs and duties. So I have a case study here. It's made up. Alpert Associates is a Mexican company that manufactures trumpets, and it's wholly owned by Domer Distributors, which is a U.S. company, which for transfer pricing purposes is viewed as the parent company or the entrepreneur in this transaction. So AA produces trumpets that it sells only to its U.S. distributor, DD, using a transfer price of $800, which is based on a transaction value of similar products that are similar trumpets that are sold by another third-party manufacturer. And so we'll use the $800 as the transfer price of the product being sold from the Mexican subsidiary to its U.S. parent company. We also assume there'll be a 25% tariff that will be imposed on the trumpets, and that will be carried in the U.S. company's inventory. So the total value would be $1,000. It's 800 times 125% gets us to that number. Now, DD, as part of its income tax compliance efforts, prepared a transfer pricing benchmarking study focused on how much profit should I earn as a distributor of these trumpets in the United States. And that analysis showed that they should earn between a 3% and 7% pre-tax margin or operating margin. And so they want to set their pricing, their transfer pricing in such a way that DD will end up with a profit operating margin within that 3 to 7% range. So you can see the methods that were used for both tariff and transfer pricing. So in this scenario, DD has three options of how to deal with this 25% tariff. They can either bear 100% of that tariff cost, so they just eat it. They can pass on a portion of that cost to their customer, or they can negotiate with their manufacturer, AA in Mexico, and share the cost associated with that. So here's the financial example, and I actually have a 10% and a 25% tariff here. You can see the impact. With no tariff, the operating margin is 5%, which falls within the range. And so for U.S. income tax reporting purposes, DD would be considered to operate at arm's length with its related party in Mexico, because the operating profit it earned for reselling those trumpets in the U.S. earned them a 5% pre-tax margin. With a 10% tariff, you can see that with the transfer price of 800, 10% is 80, and tariffs go into the cost of goods sold number, obviously. And you can see as you kind of go down, the operating expenses stay the same, but we now have a negative operating income of 30, which means we have a negative operating margin of 3%, which now means I fall outside that range of acceptable operating margins that the IRS would look at. And they could come in and say, well, we need to adjust the transfer price to get you back into that range of acceptable operating margins. So there could be a potential adjustment made by the tax authority here. The same example with the 25% tariff, obviously the magnitude of the losses is more, and therefore the adjustment could be much more significant if the IRS were to come in and look at that. So in the scenario where DD can pass along these tariff costs to the customer, and I'm just going to use the 10% tariff, you can see here they're able to say, look, we're going to add that $80 tariff, that 10% tariff, and we're just going to increase our price to $1,080, and that way the customer will bear 100% of that tariff cost. And again, as you kind of go down the math of this third column, we end up with a profit margin of 4.6% because we take operating income divided by sales, and we end up with 4.6, which falls within the range. So in this scenario where we can pass the cost on to the customer, from a transfer pricing perspective, everything is fine. We're still within the acceptable range, and it's unlikely that the IRS would come in and make an adjustment. Where we can renegotiate with our manufacturing affiliate, in this case, Mexico AA, in this scenario, we say, hey, look, let's lower the transfer price from 800 to 730 under a 10% tariff. And that way you absorb some of it, I'll absorb some of it. And as we go through the math, we can see we end up back at a 4.7% operating margin. So we're within the range and things are fine. And the same under the 25% tariff scenario. Again, we're able to renegotiate with our manufacturer in Mexico, and we end up at a acceptable profit margin from the US perspective. So now, mind you, as I said earlier, the tension here is that Mexico might not think this is a great idea. And we're probably not going to get a lot of sympathy from foreign tax authorities when it comes to these issues going forward because of the nature of these tariffs, and they seem very punitive to these foreign countries. And so we're not sure how likely they are to play ball with us when it comes time to negotiate tax audits if there are indeed losses or issues on their side of the transaction. And so that's the wild card in this. Well, we could potentially negotiate with the related party. That doesn't mean the local tax authority will accept that adjusted transfer price. They could have arguments for why the price should be higher. Which leads then to the next slide, which is not to get into too deep of economics here, but my ability as a distributor in the U.S. to pass along these tariff costs really comes down to the price elasticity of demand. So go back to your days of Econ 110 or Econ 100, whatever it was at your university. If I have a price elasticity that is greater than 1, which means my demand is strongly responsive, the demand for my product is going to change. It's going to have a high propensity to change depending on the changes in the price of that product. It becomes very difficult for me to pass on that cost to my customer. So you see this with luxury goods or things that people don't necessarily need to go buy. You're going to have a hard time to pass that price increase along. If I have my price elasticity of demand is less than 1, that means I have a weak response to a change in price. In that scenario, I'm going to be able to pass along my price increase because the customer doesn't have a lot of choice. They're going to have to purchase my product because there's not a lot of substitute goods out there. So this really comes down to the U.S. Is it a price setter or a price taker? And if they're a price setter, that means they're setting the market price. They can go out and most likely pass along these tariff costs. If they're a price taker, they're going to be limited in their ability to do that. And that at the end of the day will affect total revenue, which affects my transfer pricing because that affects my profitability at the end of the day. If my revenues are going down and my costs are going up, that means I'm going to be showing losses, and that will affect how the U.S. views my income tax filings and my transfer pricing. The other thing to consider when we talk about adjusting prices or sharing the burden of the tariffs is, does the intercompany agreement give me contractual rights to adjust the intercompany price or to share the losses under this arrangement? We ran into this problem during COVID. A lot of the distribution agreements between related parties did not contemplate an act of God, which is what COVID was viewed as. And so the question became, wait, who bears the losses associated with the COVID supply chain disruptions? And the tax authorities had to step in and provide some guidance on that. And there is some thought that the OECD and the IRS and others might come in at some point towards the end of the year, as they did with COVID, and maybe give us some guidance on how to handle some of these unexpected costs. But I think the burden is still back on the taxpayer to make sure their contracts have provisions or language in there that allow them to renegotiate transfer prices based on tariffs or how they can share those tariff expenses. As we talked about earlier, we need to consider both sides of the transaction. Also, contractually, does the distributor, in this case DD, have the right to go look for an alternative supplier, whether it's a related party or an unrelated party? That's something else to take a look at in the agreement, in the intercompany agreement. Can I delay purchasing of goods from a foreign affiliate to reduce the amount I'm carrying in inventory, which can affect in the near term my tariff costs, if I can reduce how much I buy today versus how much I can buy a year from now when maybe there's a little more certainty around that. We talked about the supply chain adjustments. The other issue from a practitioner perspective, as we now start looking at DD's financial results for the 2025 period, we're going to have to go find comparable companies that we can benchmark the returns for DD against. And those comparable companies potentially could be facing similar challenges or not, depending on the products that they're selling and reselling. We're not so much concerned about the product type as we are about the functions performed by the comparable companies. So we're going to have to be a little more careful about comparing distributors of electronic components with, let's say, fast-moving consumer goods, because maybe fast-moving consumer goods didn't have a tariff imposed, which would affect the financial results of those tested parties. Just some final thoughts on some of the things we're seeing our clients do right now. We have a lot of direct marketing companies that we work with, and oftentimes they'll source products from China into the US, and then they'll resell those to the foreign subsidiaries. A lot of those companies I work with have now told their foreign subsidiaries to buy directly from the manufacturer to avoid bringing that product into the US and then shipping it back out to the distributor. So looking for ways to avoid having product come into the US and go direct to your related party distributors outside the US is something that we see clients are doing now. Reducing the amount of inventory being purchased, I just talked about that. A lot of our clients have learned from COVID that you better have some alternatives to your suppliers in China. And so we've fortunately had a number of our clients have started to diversify their supply chains and are now relying on Southeast Asia for a lot of their product. And so that's something, again, that we see happening. They're trying to source from US based suppliers, but that's in the near term a challenge because they might not have the manufacturing capabilities. And then we're revisiting the components that make up the transaction value of the imported product. If we can strip out royalty components or other non-product related costs to try to separate those out, that can hopefully reduce the cost, the importation cost, and we can address the royalties and other issues through other transfer pricing mechanisms. So that's a lot of material we just covered. You get 10 credit hours for CPE purposes. I'm happy to answer any questions that people might have, and I'm happy to share these slides as well if people would like to look at them.
Thank you so much, Mark. Yeah, please, if you have any questions, please chime in and ask those. I did not do well in my college economics course, so maybe it's just me, but wow, this is complex information and also seems like a really great tool for companies to consider, and they should reach out to you to discuss further. A few weeks ago, we had Phil Pohl from Traeger present, and if any of you were with us then, you might recall that he was advising to be aggressive on a lot of things, including on your P&L. I think this is one way to do that, to explore doing that. So really appreciate this. Yes, we can share a copy of these slides. Looks like we have a question from Jennifer. When and how do we find out about how the other countries will accept this? For instance, Mexico. Have you seen anything yet?
Very good question, and unfortunately, we don't know yet. Everything, I think most of the transfer pricing practitioners I interact with, and I was sharing with Michelle and Ben. I was in Washington D.C. last month at a conference with a number of my colleagues, and we all agreed that it's kind of a wait and see, and I think everybody's hoping for some guidance from the OECD. That doesn't mean it's mandatory that countries follow it, but maybe they can provide some guidance that Mexico or Canada will look at and say, hey, look, yeah, this is a one-time expense that maybe we should back it out and not consider it when we're looking at the profitability of the Canadian or Mexican subsidiary. But we don't have that guidance yet, like we got with COVID. So I think we're kind of waiting and seeing where this ends up. But I do think, based on what I heard at this conference from some folks from Canada, we're not going to get a lot of sympathy because they're very upset about what's going on. And I think it's not going to be like it was with COVID, where we were all in the same situation. This is a U.S. imposed issue, and I don't know that they're going to be wanting to help us too much.
Sure, makes sense. Do we have another question? Do you see other countries adjusting their tariffs between other countries, not the United States?
Because I'm not a tariff practitioner, I can't answer that decisively. I would refer to Ben or people on his team. What I have seen, or what we've talked about, is especially with Southeast Asia, we've seen those countries that got in early and negotiated a trade agreement with the administration, I think are the ones that are benefiting right now. This is a bit of game theory that if I would have been one of those countries, I would have been the first one in line to cut my deal, because where you can move manufacturing out of China into Vietnam or Cambodia, which we've seen with a lot of our consumer goods companies, you can avoid some of those issues because they've agreed to their tariffs, and we have some stability on what that's going to look like.
What I would add to that is that the United States tries to prevent some of that from happening with some of the tariffs. For example, if you're going to do business with Venezuelan oil, or if you're going to do business with Russia or a BRICS country and sort of get outside of the orbit of US interests, well, then you're not going to have access to the US market, because you'll get additional tariffs. So we have seen tariffs that sort of head some of that off. And if it becomes too much of an issue, I would anticipate that, yeah, countries could probably see that is a likely outcome. However, allies working with allies, that's interesting. I don't know how that might play out, and I haven't heard too much on it yet or seen trends. But one thing to monitor is just working with non-allies might impose a penalty from the United States. So if you see that happening, probably something in the crystal ball that's coming.
Great thought, Ben. Well, we are at time. Thank you both so much for sharing with us today. Mark, we're getting lots of requests for the slides, so really appreciate your willingness to share that. If we can hopefully send that out to folks by the end of today, and make sure everyone who's on this webinar gets a copy, and can follow up with you with questions, because I imagine there will be more. So thanks again. Thank you all for joining us, and we will see you again next Friday at 9:30. Have a great weekend.
Thank you. Have a great weekend.